Okay, good morning, ladies and gentlemen. Let's just wait a couple of minutes. There is somebody here who has put their name in Chinese characters. And as I've told you repeatedly, I don't read, write, or understand Chinese. So if you want me to call on you, if you want to get any class participation points, please put your names in English. And your full name, please, not just a Y. I have no way of knowing what a Y stands for. Once again, please put your full name, first name, last name, please. First name, space, last name, please. And also, please, you know, this is a class. This is not an entertainment. You need to put your formal name on your signboard, please. You know, if you go by a different name, that's absolutely fine. Decide what you want to go by and have that, because I need to put this on your grades. I'm seeing a particular name here that I have no idea who that person is. You know, please put your formal name on your nameplate, please. Once again, there's somebody with just a Y. That doesn't help. And, you know, somebody's iPhone, it's not important whether you're on your iPhone or not. I need your full name, please. Please cooperate here. This is going to be extremely difficult without your cooperation. I mean, look, if your name's not there, I'm going to just give you 0 on class participation points. That's 20 points gone. If that's how you want to do it, then that's fine. That's how we'll do it. I mean, it's, you know, an overwhelming majority of you are following instructions. It's fabulous. You know, look at Sheng Xia, you know, always professional, always right. You know, these are the Gail Simonettes, always just right. Mavis Nee, always just right. You know, at the end of the day, when you're out in the real world and you're on a conference call with the World Bank or something, you need to be following instructions exactly, because, you know, it's not helpful to make the other person's life difficult here. You need to follow instructions. I mean, let me just quickly tell you, the reason I wanted all of you to follow exact instructions on the midterm exam, I said first name, comma, space, sorry, I said last name, comma, space, first name, comma, space, midterm exam, .xlsx. That's how to name your, why did I do that? Because the only way to prevent human error is to automate as much as possible. Automate as much as possible. And the only way you can automate, and you know enough big data to know the only way you can automate is if everybody follows the same pattern. If you fail to follow your pattern, if you fail to follow the format, then everything has to be manually entered, and which is like 10 more hours of work, $10,000 of my money income lost uh, at my consulting rates. But that's not the point, really. The point is human errors can happen. Overwhelming majority of you followed instructions, which was great, which is how it should be. You are students at a master's program in a top university. But just because a couple of people failed to follow instructions, I had to do everything manually. So, last name, comma, first name does not mean first name, comma, last name. Last name, comma, first name, comma, midterm exam does not mean last name, comma, first name, comma, course number. Anytime you deviate from it, we cannot automate it. And human errors are bound to creep in. So when you are getting into the real world, when we are trying to do much more big data work, and because I do all my work in big data, those kinds of things completely mess everything up. So we need to be much more careful. And I really, really urge you to follow my instructions exactly, because otherwise it makes everybody's lives very difficult. Once again, almost all of you are extremely cooperative, and I appreciate it more than I can. Hold on just a second. More than I can tell you. I'm really, really grateful for the wonderful quality of this class. So, all right. So let's get started. Is there? Hope you had a good spring break. It's not exactly a fun time for anybody, although it's been great for me having my family around all the time. Our daughter's classes are canceled, so she's at home, which I get to spend more time with my 12-year-old daughter, which is fabulous. I personally would love to, and my wife's working from home as well, so I get to be, all three of us get more to spend more time with each other, with one another. Many of you would have liked to go home for spring break, but that couldn't happen because of now they're calling it the Great Cessation, not the Great Recession or the Great Depression, but the Great Cessation, as in all activities have ceased. So the Great Cessation has caused a lot of our activities to come to a grinding halt. But we shall recover. This too shall pass. So hopefully you were able to do some interesting work, catch up on things, socialize even if remotely, and that you're back to coming back to your classwork with absolutely full energy. Okay, any questions before we begin? All right. Yes, Mavis.
No, I mean, I don't have questions.
Oh, okay. Your screen just popped up. So, all right. So today we are going to do fixed income securities. Let me share that screen. Jing Zhang, are you there?
Yes, I'm here.
Okay, can you see the screen?
Yes, I can see the screen.
All right. So, now remember, as I told you right at the beginning of the course, this is a financial economics course. This is not a mathematics course. This is about real stuff that's happening. And, talk about the relevance of financial economics for a finance course at this time. We're living through pretty eventful times. So we'll try to understand fixed income securities more with the context of what's going on. So I'll urge you to jump in with any thoughts that you might have. Okay, let's try to make a discussion happen out of this. Once again, may I remind you that you do have a large portion of your grade on class participation. Some of you have done so well that I'm already happy to give you 150% on your class participation. Oh, you know who you are. Yeah, I see that guy smiling. So please keep up the good work. I mean, it's fabulous. I mean, this whole past week, I've been on Facebook, on social media with my professors, of my friends who are professors at various universities, and they've all been. It's been a challenge trying to figure out how best to interact with everybody. So we're all trying to figure it out as we go along. So please help me out. Please jump in. And there are two things here. First is your general contribution to the whole class, because if you don't contribute, it's you learn as much from your classmates as you do from me, and your classmates learn as much from you as they do from me. So first thing is to contribute to the full class. And the other thing, very selfish perspective, 20% class participation points. It can make or break your grade. So you need to be very, please participate as much as you can. All right, so fixed income securities. All this time, we have really focused on on equity, because an overwhelming majority of the market really is equity, and equity is just much easier to understand, because debt is profoundly more complicated than equity. So what are the first things to keep in mind? First is debt is senior to equity. What does seniority mean? That only comes into place if a firm is in distress. If a firm goes bankrupt, then debt holders get paid first, and they have the first claims to the assets of the firm. And only when in principle, if the debt holders get paid fully, then the equity holders get paid anything. It doesn't exactly work that way, because it needs, and I'll show you some examples in a little while. It is the debt holders, because of their seniority, they have much more. They have more bargaining power, enormous bargaining power. So let's go back to the second bullet point, Toys R Us. Mavis, you've been in the US for a while, so you know about Toys R Us, right? No?
Yeah. Which company is that? Yeah,
Okay.
the name's familiar, but
Okay. Well, I mean, it's if you're not a parent, you probably won't know Toys R Us.
Oh, is that for the, you can see it along the highway? There's a big board of, it's for toys, right?
Right. So it's interesting, if you ask Americans your age, they will all know about Toys R Us, because when they were growing up, it was a big part of their lives, going to Toys R Us. When our daughter was younger, we used to go to this Toys R Us close to our home in Boston, and the cashiers all got to know my daughter and me. They'd be like, "Hey, Mingna, how are you?" That kind of thing. It was an American establishment. But it went bankrupt, and it was primarily the debt holders who decided they didn't want to continue working with the firm anymore, and they forced it to bankruptcy. Similarly with Tesla, Tesla is a strange firm, right? Strange is not the right word. It's a very outlier firm. And as you can see, Tesla's equity return since IPO is 1,690% in less than 10 years. I mean, that's an outrageously high return, yet its debt is junk. That is high default risk. So what often happens, if you follow Tesla very carefully, as you should, what has often happened is these debt holders, people who have loaned money to Tesla, are the ones who are trying to basically have a lot of power in terms of forcing Tesla, whether Tesla gets to stay afloat or not. Okay. Now the payoffs to debt and equity for the same firm depend on different upsides and downsides of the issuing firm. So once again, Tesla's equity has gone up 1,690%. That's equity return. If you bought a stock on the first day Tesla traded after its IPO, if you put in $100, then your amount would be worth $1,790. You know, it's a ridiculously high amount of high return. But if you had loaned money to Tesla at that time, quick thing to remember, you do not get to share in the upside. Equity shares in the upside, debt does not share in the upside. Now, what happens on the downside? In the downside, that's where the debt holders are protected by virtue of their seniority. If Tesla were to go bankrupt within the next couple of months, the debt holders would get paid first, and the equity holders will be left with what we call pennies on the dollar. Now, as you might have heard, because of Tesla's biggest growth market was China. And with the current great cessation, Tesla is not quite sure where its growth is going to come from. So both its upside and its downside is kind of a bit worrisome. You know, upside with Tesla has never been a worry. 1,690% in less than 10 years. That's a ridiculously high return. So the upside's always been good. The problem is you're never quite sure whether it's going to survive into the next quarter because it has so much debt. And there are Tesla, there are these short sellers, which short sale and constraints, I've talked about it a little bit earlier, right at the beginning of the course, but later on, because a lot of my research and consulting is on short sales costs and constraints, I will talk about short sellers and so on later in the course. Now, 2 points I'll try to make. So first of all, payoffs to debt and equity depend on different upsides and downsides. So the point is they really capture somewhat different things. So, so what often happens is yields to a firm's debt sometimes co-moves negatively with returns to its equity. Yields to debt as a whole often co-move negatively with returns to equity. Since you are students in a Masters of Applied Economics program, can you put your microeconomics hat on and try to say why those two will happen? Who wants to go?
So that moves negatively with the returns.
Yeah. Mm-hmm. No, not always. I'm saying there is sometimes. Why would that be?
Is that because of the leverage? They borrow the money from someone and
right.
Go
exactly.
Invest for.
Exactly. They're substitute investments, right? For investors, they are substitutes. So if something goes, improves, then the other goes in the other direction. Absolutely. But so the point is, it can co-move negatively. It can co-move. Why can it co-move positively? Let's look at this article. That I
So I can't find the page. It said the page is not found.
Oops, sorry, excuse me. Do you have a Wall Street Journal subscription?
Yeah.
Okay. Well, can you see the screen now?
Right.
Can you see the screen?
Yeah.
Yeah.
Okay. All right. So, so this thing here, stocks, bonds, and commodities fell Wednesday in a simultaneous sell-off. So earlier, as Shing just very correctly pointed out, they're substitutes for investors, right? But here, there is that common factor that comes into place. When the whole economy is tanking, it has the same impact on all kinds of investments. So equity, debt, even gold, even US dollar, everything is being affected in somewhat the same way, because there is that common factor. And if you think of it, if you want to put a regression, then there will be that common factor that moves across all. So the way we have, GDP per capita, or we have done with the S&P 500, all of those are the common factors which go with it. So, if you read the next paragraph, investors even shunned assets like government bonds and gold that are normally considered the safest, which rarely happens when stocks are also falling. Typically, they don't co-move positively. The covariances are typically not positive, but these are tumultuous times. These are inordinately complex times that we live in. And as a result, this, everything moving in sync, which is why I sent you this article, is that when everything is moving in sync, that can happen simply because there are these common factors. So to summarize, why will they co-move negatively? There is an incentive for them to co-move negatively because they are substitutes from the investor's perspective. They can co-move positively because there are these common economy-wide impacts on these instruments. Could you mute yourself if you're not speaking, please? Thank you. All right. All right. Now, this is for economy-wide movements. Let's see.
Excuse me.
Yes.
Would you please repeat the situation when the yield and the returns move like co-move positively?
Yeah. This is when there are common factors. Because at the end of the day, these are all returns to investments, right? And returns to all investments, they have this common factor. Is this Shing? Shing, are you the one talking?
Yeah.
Okay. All right. So that's economy-wide. Okay. Now tell me why it would hold for a particular firm. Because you said earlier the reason that not necessarily all the two factors, right? There are reasons to co-move positively. There are reasons to co-move negatively. So economy-wide, we just discussed, and that's what this article talks about. Can you tell me why it would make sense? What are the incentives or what are the reasons for them to co-move negatively?
Move negatively is because of the there are substitutions from investors.
Right. And why would they co-move positively? Or what are the incentives for them to co-move positively? Take Tesla, for instance. So Tesla's debt and equity, what are the reasons for them to co-move positive? You've very well articulated what the reasons are for them to co-move negatively. Tell us.
Because of the higher returns, or like stronger future estimation from the. I mean, since Tesla could produce, I mean, has a very big association with the power.
Yeah. Okay.
The reason.
Okay. Gail, would you like to jump in and tell us what you think? What the reasons could be? We have already figured out the reasons why Tesla's debt and equity returns can co-move negatively. What would be the reasons for them to co-move positively?
I think they're raising cash out of the investment.
Right? Exactly. Because both of those, thank you, are in our returns based on the firm's overall prospects, different prospects, right? The equity is on the upside, the and downside, but the debt does not get the upside, but is protected from the downside. But if the firm is doing very well, if bankruptcy is not an issue, then both of them would be mostly moving positively. So yes, so the overall cash flow, if the increased cash flow, the firm's doing overall better, that will cause both of them to the returns of debt and equity for a particular firm to co-move positively. Okay, any questions about this?
Yeah, actually, I do. I do understand, like, because equity and both equity and debt are ways to finance the company, so they can go up or go down like at the same time. But I just don't get why the art, because I don't quite get, in common sense we usually see gold, the value of gold goes up during like bad times, during war or recession, because that's how much that's how much gold on earth. I don't understand why, like, during this pandemic, both gold um, and the treasure bond goes down.
Right. Who is this? Who's talking?
Mavis.
Mavis. Yeah, I mean, yeah, that's a very, very sophisticated question. I don't think anybody fully understands that. This is the first time in the, I mean, in the decades that I've been following the financial markets, that I've seen gold go down in a bad situation.
Sir.
Gold is the ultimate safe investment, right?
Yeah,
But,
yeah, I saw. Yeah, it just doesn't make sense. Usually, it just goes up during that time.
Right. And
Sir.
that's what we often refer to as a recession. And I'll talk to you in just a minute, the yield inversion is we're saying that, you know, this is a situation where people don't know what's going on. People don't know what to make of anything. Is this is really, I understand your, I mean, I can see it from a mathematical perspective. I can look at the data and see why that is the case, but I cannot explain it in terms of economic theory as to why this should happen. I completely agree with you. I don't, you know, that's a very good question, and I don't think anybody has the answer yet. If you want to,
Sir.
this is, yes. Sorry, who is
Oh
this?
yeah, it's Jane.
Hi, Jane.
Yeah, I read an article about the gold, the decrease of the gold, and they point out that because people are worried about for example, people are stocks food and papers, so they need liquid. That's why they took out the money from the gold stock.
Okay. Okay, that's a very good reason. Yeah, in fact, there's an article in the Wall Street Journal as well about exactly this issue, that a lot of returns are going out of the stock market because of this liquidity crunch. Yeah, so you know, particularly in India and China, there is this idea of using gold as a store of as a store of money, instead of, because that's the, you know, in the, you know, I guess India is still there. China probably not as much, because China has, you know, really developed as an economy. India still, even a few years ago, the only thing that people really trusted was gold, because that's the, yeah.
Somehow in China we still do.
Sorry?
I think somehow in China we still do, because
Still do? Okay.
like money is paper, but gold is gold.
Gold is gold, right? Yeah.
Yeah.
Right. So, okay, Jing, that's a very good point. Liquidity, that would be Mavis. You and Jing should have a chat, and maybe you can figure something out. We don't have the paper option for this course anymore, unfortunately, but I'm always happy if you want to write a paper together. I can tell you the data sources. I can, you know, guide you. This is something to continue going forward. Particularly when you're applying for jobs, a paper like this would really look very good on your applications. And I'm perfectly happy to make that part of my recommendations going forward. Okay. So yeah.
Thank you so much.
You're most welcome. And yeah, liquidity is, in this. So, okay, now, when you go through times when the liquidity itself is binding, then, you know, all bets are off. You're cashing in your T-bills. Those are not investments anymore. Those are liquidity issues. Yeah, so it's the budget constraints binding. Well, all right. Any further thoughts?
So would the liquidity be the main reason why USD is appreciation?
Sorry,
US dollars.
um,
This is Shin, and so I've realized the exchange rate for USD US dollars has been increasing. Would that be the same reason due to the liquidity?
no,
No,
actually,
Liquidity.
it's not.
okay, who's this?
It's Jing again. Sorry,
All right, Jane, come on. You're on a roll today. I love it.
because I really want a participation point.
uh,
Yeah, because the I think the currency is because of the import and export, right? Because the import of the US, because the export of the US decrease. That's why in the market we don't need. People don't want that much of the US dollar to buy US stuff. That's why the US dollar depreciate, right? Oh, the US dollar appreciate. Is that true?
Um, we will later on talk about foreign exchange. We will go into details. And, basically for a foreign exchange, there are two aspects that go into it. One is the export-import market, and the other is about quote
Interest rate.
unquote, yes, interest rates, and finally about the speculation idea.
Okay.
And the US, and I think in this particular case, the effect suggested by Sheng might be the more important one, because historically, gold and US dollars were the resources of last resort, the investments of last resort. Anytime there is, because the US has historically been the most stable country because we have never defaulted on any of our debt and so on. So anytime there is an increased demand for US dollars, in terms of crisis. But the point that Jing you made, that's something, please keep this in mind and bring it up when we do foreign exchange, because that's where the most of the action is if how imports and exports affect the relationship between, let's say, the USD and the RMB. But in this case, it might be more the flight to safety. Look, I honestly don't know if gold is affected, whether the US dollar will also be affected negatively. But of course, the difference between gold and the US dollar is the US dollar can be used in a liquidity situation, whereas gold cannot be used in a liquidity situation. So there is that. There is that issue. Now, question is, okay, now please tell me, who can I ask? Okay, Yunshu, I'll ask you this. How do you think, if you were to go to a store in Beijing and just pay by US dollars in cash, will they take it?
I think whether they will take the US dollar depends on the situation. If I go to the store in the airport, the Beijing International Airport, maybe they will accept it if they knew. Like I just went back from the US, if it is just a common store like the one in the supermarket, I don't think they can.
I see. I mean, India is a bit different, but I mean, but then again, India has been integrated into the world economic market for much longer. Yeah, I mean, US dollars, British pound, German marks, Japanese yen. You can pretty much use it. Maybe not at a fish store, but anything above that, people will gladly take US dollars. So going back to the liquidity idea, thank you very much, Yunshu, for that. That's very good to know. In terms of liquidity, in China, for instance, people are holding US dollars as assets. If going from what Yunshu just mentioned, if they want to pay for their expenses in China, they will then have to convert it into RMB to do so. So that will then put a downward pressure on the US dollar. But whereas in more capitalist economies like like the Western economies or India or South Korea or Japan, it probably wouldn't make that much of a difference. So the point is, this is a, I don't want to get too much into talking about foreign exchange and other things because we will get to those later. But I'm really, really glad that we have had a chance to talk about this in the context of fixed income securities. Any questions, or should we move on? Okay, so the question then becomes, how should a firm finance itself? So Xing, you mentioned earlier about leverage. So leverage is simply the level of indebtedness of a firm. How much of its total financing comes from debt is a function of leverage. And Modigliani-Miller theorem, which is Nobel Prize winning work, it is posted on Blackboard. It says, doesn't matter. Absent tax implications and transaction costs, which of course are big assumptions. I mean, the idea is that if returns from debt and equity are both taxed in the same way, and there are no transaction costs in moving things around, it does not matter whether you finance yourself with debt or equity. And the idea is quite straightforward. The more leveraged you get, that is to say, the higher the percentage of your total financing comes from debt, your risk of default goes up, and therefore you will have to pay more in as a return to your fixed income securities on your debt. Okay, the less debt you have, the less the default risk probability, and therefore the less the default premium that you will have to pay on your debt. So, so this is what the famous Modigliani-Miller theorem is, that it does not matter. It is a profoundly important seminal work in financial economics. It's a good starting point, and it doesn't always work because these tax implications. In fact, in the U.S., debt and equity returns are taxed differently, which we will get to in just a second. So there are issues. A person like me who really believes in very little taxation, very little role of government, the idea that two different kinds of returns should be taxed differently is blasphemy, is so wrong. But bureaucrats and politicians, who knows why they do things? They don't listen to us experts in finance. I mean, they do things. Lawyers. What do you do? Some of my best friends are lawyers, but it is what it is. All right, let's move on. Okay, so bond is just a security that is issued in connection with a borrowing arrangement. Now, equity is a bit more complicated, right? It's a partnership. You're investing in a company with, we talked about the examples and so on. Bond is much older than that. Bond is, or a debt of any kind is, let's say, Hanshu, let's say you took a loan to come to the US to study. So that's a debt. The idea is you take a loan, and when let's say you borrowed $100,000 at 10% interest per year, and then it's due in 5 years. For every of those 5 years, you'll have to pay 10% in interest, and then you'll have to return the principal amount. Debt is a very straightforward thing. That's not quite right. It's not it's a straightforward thing, but it's something that we understand very easily. But it can it can, and the reason I mentioned is profoundly more complicated is because of the various different characteristics that come with it. Okay, so what exactly is how does a bond work? The borrower issues or sells really a bond to the lender for some amount of cash. The arrangement obliges the issuer to make specified payments, and these are the fundamental characteristics of the bond. The face or the par value, the amount paid by the issuer when the bond matures. So Hanshu, if you borrowed $100,000, if you issued a bond as a debt in general, then that's the face or the par value, the $100,000, the capital that you would have to return. Coupon rate is the percentage that you're paying out of the face value of the bond. Okay, so if we said 10% interest, then that's the coupon rate. Maturity is the final time that the bond contract is due when it has to be paid. Okay, in a few minutes, we'll talk about, there are various kinds of bonds. Some of them are, various options that go into it. You can have a callable bond, a puttable bond, like what a dot of Tesla has, that after a certain amount of maturity, after a certain period, it entitles the bondholders to convert their bonds into equity. And Tesla also has some interesting provisions where if the equity equity price goes below a certain point, then it entitles the bondholders to get further provisions at a particular strike rate. So there are all kinds of optionalities that often can make bonds much more complicated, which is why I started out with saying bonds are just, profoundly more complicated. I used to say infinitely more complicated until one of my students at the University of Maryland stopped me and said, "Professor, you shouldn't use the word infinitely so easily." And I'm like, yeah, you're right. I like to be precise. So not infinitely more complicated, but it's profoundly more complicated. And because of all these, now remember, in equities also, we have really dealt with simple equities. Mostly, but there are all kinds of convertible equities, preferred equities, and those are things. So we are going to, this is if you were doing a full course in fixed income securities, which I'm probably going to offer in the very near future, in which case we would go into far more detail on these optionalities and these various convertibilities and so on. For our purposes right now, we are going to focus on somewhat straightforward bonds. Auction rate securities are a very interesting mixture of some of our applied microeconomics and bonds. Is that the rate of payment, the coupon rate is determined by auctions every week, for instance, or every quarter, every month, on a regular interval. So if you buy an auction rate security, the idea is that you agree that the rate will depend on the various investors, how much they want it, how much they auction for it, and so on. Okay, so I actually was involved in this, reasonably complicated auction rate security. Basically what happened was, I'll just give you a very, very brief overview. I don't want to get into detail on this because that's not the objective today, because this is, just one class on fixed income securities in a full course on financial economics. So, basically what happened was, these investment banks, they sold auction rate securities as essentially risk-free, similar to just cash investments. However, what happened was, these investment banks in the auctions, when they were bidding, they actually started manipulating the auctions, as in colluding with each other and so on, to keep the rates down artificially, so that they did not have to pay the investors as much. So there was some manipulation, at least that was the allegation, and as a result, there was some litigation around it. If you want to me to discuss this in more detail, we can do that as we go forward. Any questions before we move on? Okay, so what determines interest rates? So if you have this, from microeconomics, the x-axis is funds, dollar amounts, and the y-axis is the rate of interest. Then you have the demand for loanable funds. There's a demand curve, and there's a supply curve, supply of loanable funds. The demand curve for loanable funds is downward sloping, as we would expect, because the higher the interest rate, the less the demand. As the supply for loanable funds, the higher the rate of interest, the more as me as a household would be willing to supply to this particular market. This kind of gets into, okay, how many have you done? Are you familiar with the ISLM curves of Oh, can I? Okay, Rundan, Guan. Are you familiar with the ISLM curves of macroeconomics?
Yeah.
Yes. So you can see. So remember, so um, this supply, so you can see where from the ISLM curves, this the supply of loanable funds that has to be an upward sloping curve, and where they intersect gives you the equilibrium rate of interest. The equilibrium funds length is not that interesting. What's interesting from this curve is from this diagram is the equilibrium rate of interest. That is the case. So Rundan, if there is um, um, uh, walk us through what will happen if there is an increase in economic activity. Right now, the Great Secession or the Great Recession or the Great Depression are very unusual events. Let's say, you know, between 2016 and 2018, when the economy was growing, walk us through how these curves will shift and what will happen to the equilibrium rate of interest.
The economics increase, then the demand for loanable funds will increase.
Okay.
And then the supply will increase with the demand. Then
Why should the supply increase?
let me see. I have forgot about some of the reasons.
But keep it simple. Let's say the demand for loanable funds, because the firms want to, they're growing, they want more money to invest and so on.
Yes.
So the demand for loanable funds will move to the right.
Yes.
So this demand curve, it is here, it will move like this.
Yes.
Okay, what is that going to do to the equilibrium rate of interest?
It will increase.
Correct. Very good, Randa. Excellent. All right, so that's, you know, we later on when we do foreign exchange as well, we'll see how those simple supply demand diagrams that we did in high school or college really still can be very helpful in these kinds of situations. Well done, Randa.
I have a question.
Okay, go for it.
So the supply of loanable funds will not change in the short term. Is that right?
There is no direct reason for it. Why, you know, if the economy is increasing, you know, remember that's what I was saying, the investment equals savings, the IS from Keynesian macroeconomics. The source of investments is household savings, right? For the supply of loanable funds to move in any direction, given the same rate of interest, you're asking if there will be an increase in savings. Now, you can potentially argue that there will be, if the economy goes up, people will have more income and therefore will save more. Is that the argument you're making?
Yes, but you mean that we don't have the evidence that people will save more? We just
right. I mean, that could very well be the case, but yeah, at this point, we don't necessarily need to discuss that. In what is critical is that the demand for loanable funds will move to the demand curve will shift to the right and cause an equilibrium rate of interest to go up. So that's the first order condition. But so the second order condition is if the economy improves and people have more income, as a result, they save more, then at the same equilibrium rate of, for the same rate of interest, the supply curve could move to the right.
Right.
Yeah, in which case, if this moves to the right, this moves to the right, then we have no way of knowing what's going to happen to the equilibrium rate of interest.
Yes, so we don't know what will happen to the equilibrium of interest, and but we can know that the funds length is increased.
Correct. So once you bring the second order second order effect into account, then it becomes a bit more complicated. So this is exactly the kind of thinking I was hoping you that you would do, and what this diagram helps you is to kind of think through these issues. Very good. Any other questions?
No, thank you.
You're welcome. All right. Now, yield is complicated. It's very, very complicated. Return on fixed income security is extremely complicated. So I'm going to, current yield is the coupon divided by price. Coupon is if something is sold at the price, then coupon is your rate of interest. Rate of interest is the coupon is but once you, let's say, buy a particular security, then you can sell it. You can buy a bond and sell it on. That's how it happens. When we bought our home in the US, it's pretty standard for people to buy a mortgage to take a mortgage on for 80% of their home value. So when we took the mortgage on our home here in Montgomery County, Maryland, the mortgage was immediately sold on to another company, and it's often gets sold on many, many times. So let's actually go through some calculations, and we'll see how this goes. Yield to maturity, which is by far the most important calculation to keep in mind, is that rate for which the discounted cash flow equals the price of the security. Right? The point to keep in mind is be very careful that you understand exactly what is meant by yield in a particular context. I've often found, especially lawyers who claim to be expert in finance, have absolutely no idea what they're talking about when they say yield. You, as people who have done a course on finance with me, should be able to explain yield to maturity, and let's do some calculations. Hang on just a second, people. So I'm opening up the yield calcs Excel file that's available on Blackboard. So if you want to open it and follow along with me, that would be great. Okay, it's not letting me share. So hold on for a second. Okay. All right, can you see the Excel spreadsheet? Yishi, can you see the Excel spreadsheet?
Yes.
Okay. All right. So let's take a simple bond where the coupon rate is 7%. That is to say, every year you will get 7% in interest. So the face value is, let's say, $100. And each bond you buy, it's $100. Every year you will get $7. 2 years maturity. So it will mature in 2 years. 2 years later, you will get let's say you are the one who has bought the bond. So I have the one who has borrowed money from you. So I will pay you $7 every year. And then at the end of 2 years, I'll pay you back the face value, the $100 as well. So this is it. So now let's make it simple. A lot of times, these payments, what the specific regular schedule of payments depends on the bonds. And that's another reason why I've said fixed income securities are profoundly more complicated than equities. So this here, the half yearly interest payments, that can be easily changed to monthly interest payments. Okay, so half yearly interest payments. So number of years into the future, half year into the future, you'll have to pay half of $7, $3.50. 1 year into the future, you have to pay $3.50. Year and a half into the future, you have to pay $3.50. 2 years into the future, you have to pay $3.50. After 2 years, the bond matures, you'll have to pay $100. All right. So what are the cash flows to the investor? After half year, it's $3.50. After 1 year, it is $3.50. After year and a half, it's $3.50. After 2 years, it's $103.50. Okay. So now let's do the discounted cash flows, which we have done in gory detail in the past. So discount this cash flow, which is a half year into the future, to today at the rate of this E1. Remember what I said? So we are going to discount it at this rate, E1, and we are going to find that rate for which the discounting gives you the same price. So let's discount it at this rate, E1, not at the coupon rate, not at the coupon rate. We're discounting it at this particular rate. That's what we are going to solve for using solver. So how do we do this? This is E4 divided by 1 plus E1 raised to A4. So E4 divided by 1 plus the discount rate rather, raised to, in this case, half a year, raised to the amount of time. That's the discount, this $3.50 that you are getting in the future is being discounted to today at $3.30. The $3.50 that you're getting in the future, getting into 1 year into the future, is discounted to today exactly the same way. The $3.50 divided by 1 plus E1, this rate, the discount rate, raised to the power A5, which is 1, raised to the power A. Similarly, this $3.50 a year and a half into the future, discounted to today, so it divided by 1 plus the discount rate, raised to 1.5, because that's a number of years. And finally, you get $103.50 into the future, 2 years into the future, that is discounted today, E7 divided by 1 plus discount factor, raised to the discount factor squared. Okay, so this is what you get. So the discounted cash flow is simply the sum of these four. Okay, who wants to answer this following question? What if the discount rate is 0? What's going to happen? Zhen Rang Wang. Okay, sorry, who wants to?
If the discount rate is going to be 0, then it won't have any change. The value of the coupon going to be the same.
I mean the discount.
I mean, like the discount cash flow going to be the same as the coupon, the value of the coupon.
Excellent. Sorry, I couldn't figure out because your screen didn't show up. Could you
It's
identify?
Jane.
Okay, thank you again. So in fact, let's do this. 0, look at that. As Jing very correctly pointed out, the cash flow to investor is exactly equal to the discounted cash flow. The cash flow to the investor is equal to the discounted cash flow. Cash flow to the investor equal to discounted cash flow. Cash flow to investor is because you're not discounting the future at all. All right. So this is just to make sure we're getting it right. the discounted cash flow is in this case equal to 114. If instead of 0, if it were 10%, then the discounted cash flow is 95. If instead of that it is 3%, then the discounted cash flow is $107.75. These are the different discounted cash flows we get. Everybody with me? Now, let's start off with, because remember, the face value is $100, right? So let's say the price is at par. That's what we call it, at par. That is to say, the price is the same as the face value. Then we say the bond is selling at par or trading at par. Then what do? First thing is we go to data, go to solver, and we say set objective. Okay. This here we say is the absolute difference between the discounted cash flow and the price. So in this case, we look at this, then the discounted cash flow is $7.75 above the price if the discount rate is 3%. We want that value of the discount rate for which this absolute difference is as close to 0 as possible. Okay, go back to what we said earlier. The yield to maturity is that value of the discount rate such that the discounted cash flow is equal to price. That's the definition of the yield to maturity. Okay, so let's say we have the price is equal to $100, then the absolute difference is $7.75. We go to solver and we say, what is our objective? Our objective is to have F10, minimize that by changing variable cells E1. Should we make the unconstrained variables non-negative? Excuse me. Well, let's see what happens. Let's see for now, we say that interest rates can only be positive. Let's say that is the case. Click on solve. Okay. What do we get? In this case, the discount rate and the coupon rate are really exactly the same. Because if it is selling at par, then the discounted cash flow is equal to price and the yield to maturity is equal to the coupon rate. Okay, before I go to spend, I just wanted to this thing. Current yield is the first approximation you should always make to an yield. And the idea is the current yield is simply equal to coupon divided by the price. And the idea is the coupon rate, that is to say, if you're at $100, you're making 70. However, if the price is $90, then you're making $7 on $90. So the rate is $7 divided by 90. So let's say instead of price being equal to 100, when the price is equal to the face value, then the current yield and the coupon rate are exactly the same. However, let's say the price is 90. Then you're getting $7 on, instead of $100, you're getting $70 by paying only $90. So as a result, you're getting a significantly higher current yield. Let's say the price is $50. I'm just making it up. Then the coupon rate is $7, which means that you make $7, you invest $100, you make $7. But if the price is $50, you can buy this bond for $15, but get $7 a year. So it is the equivalent of getting $7 on a return on $50 of investment. So it's a $14 current yield. So current yield is the first thing you should do at all points of time and work with it. All right. So excuse me. Sorry, did anybody have a question?
Yeah, I'm Chen Lu. So I have a question. Does that mean the absolute difference, if that difference is above 0, there's any chance that can arbitrage?
Let me show you an example.
Okay, thank you.
Okay. Let's say the price is 150. Okay.
Yeah.
Um, and we say we're going to change F10 by changing variables E1, minimize it, make the unconstrained variables non-negative, solve. You see, there's an absolute difference of $36. The yield to maturity is now 0.
Oh, so like it's impossible like in reality.
Not necessarily, not necessarily. Let's go back to this and say, well, maybe the rate of interest can be negative. Click on that, solve. And here you have a yield to maturity of negative 13.3454%. Now that's pretty huge. So instead of that, let's say we say the price instead of 150 is, let's say, $136. Go to solver. Don't require it to be non-negative. Solver. It is negative 8.814%. Then you can get the price equals thing. So let's say it is 135.25. Okay, so it is negative 8.551%. So yes, going back to your question, you can, negative interest rates are, would contradict almost everything that we have learned about finance, right? Discounting the future and so on. But on the other hand, like Western Europe has seen negative interest rates for a while. And I'll show you some example. If you have inflation protected securities, for instance, where the real interest rate is often negative for US treasuries as well. All right. Okay. So it's very unlikely, but if the price is high enough, then that is possible. So that is where it is trading at a premium. What if it is trading at a discount? Since you're trading at $100, it is trading at a discount. What will be the yield to maturity? Solve it. In the yield to maturity, if it is selling at $99, then the yield to maturity is pretty close to the coupon rate. It's only 7.69%, but the coupon rate is 7%. The current yield is 7.071%, and so on. Any questions?
No, thank you.
Okay. Now, this arithmetic computation is something because, our, going back a few decades, calculating all of this was quite difficult. They didn't have advanced solver, so it was going to be. So what they often did is, here we have said that whatever the discount rate is, raised to the number of years. Instead, you can also say, I'm going to, because you're being paid semi-annually, treated this instead of 7% per annum, 7% per year, treat it as 3.5% per half year. And then you raise it to the number of half years. Okay, that's the only difference between columns F and G. The column F discounts it at the rate of the coupon raised to the number of half years. The arithmetic column, it says that instead of the rate of the discounting will happen at half the discount rate per half year. Here it is discount rate per year. This is half of discount rate per half year. As you can imagine, the differences usually are pretty minor. So here you can see it is 7.69%. And let's go over here. Let's do it for the same thing. Solver, Instead of F10, it is G10 that we are minimizing by changing the same variables. Solver, it is 7.548%. So they're pretty similar, not surprising. Okay, so this is you have a general coupon for 2-year maturity. All right. Now, this is something I often will ask is, is what happens when you have a 0 coupon bond? Is that even a possibility? The US Treasury issues a lot of these 0 coupon bonds, which is let's say I'm the US Treasury. I sell this 0 coupon bond to you. Let's see, who can I? Botol Shia. Can you try to explain to me how, so if I were to, I'm the US Treasury, I sell you a 0 coupon bond maturing in 2 years with semi-annual interest payments. Can you walk me through the payment structure? Botao Shia. Okay, Bo Zhao. Kehan Chen.
Yes.
Okay, so if this is a 0 coupon bond, please walk us through the payment structure. How will it work? So once again, it's a 0 coupon bond maturing in 2 years with half-yearly interest payments. How is that going to work? All right, so if the 0 coupon bond maturing in 2 years, it means half-yearly interest payments are exactly equal to 0. And 2 years later, you repay the capital. So on the face value, there are no interest payments. So if the discount, if the interest rate is in fact positive, then it will always sell at a discount. So if it is selling at 90%, so the price is 90%, excuse me, let's just make it, let's say it's 99%, then let's go to solver, minimize F10 by changing variable E1, solve, it is equal to 0.504%. So if it sells at $99, then the yield to maturity is 0.504%. All right. So right now, for instance, treasuries are, the yield on treasuries is pretty much in that 0.5% level, which means a treasury 0 coupon bond will sell at somewhere like $99. What if it is $90? Then we go to the same thing, solve it. It is 5.409%. All right. Sorry. Mavis, do you want to tell us what might happen if it is, let's say, $101?
Same. Using solver?
Or when would it, yeah, we will do the solver, but what will happen, what does it mean for a 0 coupon bond to sell at a premium?
It should be negative.
Right, exactly. So in this case, you are paying somebody to hold your cash.
Yes.
And, you know, in principle, that's impossible. But in this case, I'll have to allow for it to be negative. Okay, so it's negative 0.5% if it is selling at a premium. You know, the idea is quite straightforward. I mean, as we have seen with petroleum, there has been a lot of work going on that the price of crude oil can actually become negative because storage costs are can be quite significant. With you know, we are used to the idea of cash, storing our cash. It's you park it in a money market account or a checking account or a savings account. That's pretty much free. But you know, but banks often will charge you amounts to just keep your money. So storage, once you bring storage accounts costs into account, one very well can see that you would be willing to pay somebody to hold your cash for you. So you know, a negative interest rate or a negative yield is something that goes fundamentally against many principles of financial economics, but you know, it's entirely possible. Any questions? So what happens? Let's just look at if it is $95. Go to solver again. Then it is 2.598%. So once again, the yield to maturity is that discount rate for which the discounted cash flow is equal to the current price of the bond. Okay, Shan He, can you tell me if for a zero coupon bond, what can you say about the current yield? Gail Simonet.
Yes.
What can you say about the current yield of a zero coupon bond? Remember, the current yield is coupon rate divided by the price.
So, because the coupon was zero, the current yield is going to be zero as well.
Right, exactly. So no matter what the price is, the current yield for a zero coupon bond is still zero. And the idea is, you know, yeah, you might be paying $50 for it, but you're still getting zero return. So that's where you can see current yield is not a very good measure of yield. It's a good starting point. If you're running short of time and you're having a very quick conversation, do the quick current yield calculation just to get it in your mind. But, you know, in order for you to do a more sophisticated calculation, you do need to do the yield to maturity. That really is the standard measure of the return on a fixed income security. Very good, Gail. Let's go to one other example. Let's say we have a general coupon with 5 years maturity once again. So let's say we are starting off with let's say a 3% coupon rate, which means it's maturing in 5 years. Every half year into the future, you get half of that $3 as a half yearly interest payment. After 5 years, the capital is repaid. So the cash flows of the investors are $1.50 in each half year until the end of the 5th year, when it is $1.50 plus the principal amount. The discounted cash flow is, once again, if it is zero, then the cash flows are exactly the same as the discounted values. We do all those calculations. The discounted cash flow here is the sum of all these discounted amounts. And let's say the price is, what if the price is 100? Then, all right, who wants to, okay, Botao Shia, are you there? Am I not pronouncing your name correctly at all? Because you're not responding. BOTAO. Are you there? Okay. Kai Shu. Are you there?
Yes. Yes.
Okay. All right. Please tell me what you think, what's going to happen if the price is equal to $100.
Pardon?
If the price is equal to $100, what will be the yield to maturity? All right, let's actually do the calculation. Okay, who wants to tell me, because this is something we just discussed earlier. If the price is $100, means the bond is selling at par.
Yield to maturity should be equal to coupon rate.
Right, who was that?
Mavis.
All right, Mavis. Well done. So let's make sure the numbers are the same. Just solve this. F16 to F16, yes, by changing variable cells E1, minimize that, solve. Yeah. So the yield to maturity, this is rounding error. So the yield to maturity for something at par is equal to the coupon rate. Okay. So now if it is selling at a discount, so let's say it is at $99, then similarly, we solve it and the yield to maturity. Oh, just a second. Is equal to 3.244%. Let's say it is even more at a discount. Go to solver, do the same calculations. It is equal to 5.373. What if the price is, and we'll see something, what if it's selling at $10? The yield to maturity is 77%. Okay, so and the current yield is 30%. All right, what if it is selling at a premium? So let's say it is $110. Then the yield to maturity is substantially lower than the coupon. It's just about 1%. The current yield is 2.727%. What I'll ask you to do is to go through the similar calculations for the zero coupon maturity. And one thing I will ask you to do is to take this, this is the exercise for you. Take a 5-year maturity coupon with interest payments made monthly and do the calculations, do the similar spreadsheet for such a bond and in order to calculate the yield to maturity and the current yield. All of you should do it as an exercise because that will make sure you understand. Now, we did all of this yield to maturity because I want you to understand yield to maturity. Excel actually has built-in commands that will calculate the yield to maturity for you. But the point is, by doing that, you don't understand what the yield to maturity is. When you are in front of your clients or your manager, you should be able to explain what this yield to maturity is. So that's why we have gone through all of this stuff. Any questions?
Just confirm, it's you want us to do 5-year zero coupon bond, coupon paid interest monthly?
Correct, yes.
Okay, yeah. So the monthly interest, right?
Monthly interest, correct.
Okay. Yeah.
So you can see, Mavis, it's actually very straightforward, right? Instead of 2 rows per year, you'll have 12 rows per year. So it'll be a much longer spreadsheet, but the idea is exactly the same, right?
Yeah. Mm.
Yeah. All right. So okay, so once again, I cannot emphasize enough, be very careful that you understand exactly what is meant by yield in a particular context. You can go fixed income securities, you know, I know this in like Goldman Sachs or Morgan Stanley. The fixed income people, everybody kind of leaves them alone because nobody really understands what they do. Because they'll throw out all these words. There are so many measures of yield. Okay, if this were a full course in fixed income securities, I would walk you through, like there would be 2 classes on just different yield measures. Okay, so be very careful. I can walk you through some more stuff if you want, but know what the yield measure is. It is, you know, and you should be able to articulate it and so on. The yield spread, which we will talk about, I'll show you some examples in just a minute, is the, excuse me, is the difference between the bond's yield and the yield to maturity of a comparable maturity treasury coupon security. So why would there be this difference? It is the default premium. A comparable maturity treasury coupon security, the idea is that is risk-free. There is 0 default probability. So the only reason that the yield to maturity of my bond gets a higher return is because of the increase, the higher risk of default, okay, which we will talk about in just a second. So to summarize these different yield measures, if it is selling at par, then coupon rate is equal to current yield equals yield to maturity. If it is at a discount, then coupon rate is less than or equal to current yield less than maturity. If it is selling at a premium, then coupon rate is greater than current yield greater than yield to maturity. And what does discount mean? Discount simply means that the price is lower than the face value. Premium simply means the price is higher than the face value. Okay, Gail, what you had, basically it's the answer that you gave me earlier. When does this weak inequality hold? I said coupon rate is less than or equal to current yield, right?
Yes.
When does the weak equality hold?
When the coupon rate is 0.
Yes, thank you. All right, let's move on. Okay, so this is the yield spread. Now, there are bonds are rated very heavily, and I'll get to that in just a second. There are various credit rating agencies that investigate the default probabilities of different bonds. And there are these investment grade bonds where the default probability is low. And then there are the junk bonds where the default probabilities are high. So as you can imagine, if the default probability is high, there will be this higher default premium. So what is that yield spread? It actually varies a lot. People have often asked me, can you please, this is in my consulting, I get this question, can you please give me a number for when, how much a junk bond should yield over and above the treasury rate? I'm like, it depends. Look at this graph. So what is this? This is the, for junk bonds, the yield for a yield of a junk bond minus the yield of a comparable maturity treasury bond. So as you can see in the early 1990s, it was just about 2.5%. It goes up to about 6% in the late 1990s. Then it is in the early 2000s, it is 8. In the dot-com bubble and burst, that default premium, the yield spread goes up to 10%. Now, in the Great Recession between 2008 and 2010, the default premium went up to 20%, which is to say that the markets then putting in is imputing a very high probability of default for these for the bonds issued by risky companies. All right, so that was the Great Recession. So not surprisingly, there is a much higher spread default premium because of the high risk of default. Now, all the way up to 2020, you see, because things were going pretty darn well. And then right at the end, you see this huge spike. This is the spike. This is the coronavirus spike. This is the Great Recession. Suddenly there is this, this is, and we'll see some numbers very shortly, in the last, really 2 to 3 weeks, that everything's just gone completely awry in the world markets. And as we see in the last 2 to 3 weeks, there has been a substantial increase in the risk, in the default probabilities of different firms. And as a result, these junk bonds are having to pay a significantly higher default premium. Any questions? Okay, so who issues debt in general? Okay, so first is U.S. government, various different U.S. governments. The U.S. Treasury does most of its what we talk about in general. Is that there are various different maturities, less than up to a year, and so on. Remember, I was talking to you about the different taxation rates. The coupon income is taxable at federal level, but not state or local level. And let's look at some data. And before I do that, the Fed Reserve, which is the bank to the banks, sets the federal funds rate 8 times a year. And this year, a couple of weekends ago, it's on a Sunday night, I actually listened to the entire broadcast where they brought down the federal funds rate. The federal funds rate is the rate at which banks can borrow from each other overnight without collateral. And the federal Reserve sets that rate. The Federal Reserve does not set interest rates for the country. Okay, this is a capitalist economy. The government does not have the right to set interest rates for the whole economy. Individual banks and mortgagers and all of those firms decide interest rates. Okay, that's how the U.S. system works. The only thing that U.S. can do, the U.S. Federal Reserve can do, is to set this federal funds rate. This is the rate at which banks can borrow from each other. So think of it, it is a cost factor. Okay, for banks, that is one of the cost parameters into its production function. Okay, so so you would imagine, because when the banks are then lending out money, this cost factor, if that particular cost goes down, they'd be willing to lend at a lower rate and so on. That's the idea of a stimulus. That's the idea of putting more capital into an economy. But U.S. government, the Federal Reserve, cannot actually control the interest rates beyond setting this Federal Reserve Fund 8 times a year. So let's go now. I'm going to take out a 12B, Treasuries and Fed, monthly rates. I'm not going to spend too much time on it. Okay, so so this here, all treasuries and Fed funds, there are just so many different kinds of bonds here. I've just put the monthly rates, and I have the data here from essentially from the beginning here, from the 1919. So there are these T-bills auctions. You have the Treasury composite over 10 years. There are these Moody's AA rated, Moody's BAA rated, Moody's and S&P. These are the credit rating agencies that determine where. So this here is the federal funds rate, and I'm going to get to that in just a second. Then you have various different interest swaps rate. Then the Treasury constant maturity inflation indexed rates. Let's go down. So Mavis, what I was mentioning to you, that
Yes.
interest rates can sometimes be negative.
Yeah, it happened in Japan before, right?
Right, yeah. But in the US, we have only seen negative rates for inflation indexed treasury securities. So these are rate of interest. So these are real rates of interest, not nominal. In the US, we have not seen negative nominal rates yet. Could we see it? Entirely possible, but we haven't seen it yet. But in January 2020, the Treasury constant maturity inflation indexed 5-year return went down to negative rates. Okay. So these are, huge, this is the federal funds rate that I was talking about. This is the only thing that the US government, well, the Federal Reserve, which is, by the way, independent from the US administration. This is something for, it's kind of difficult to think about it. The Federal Reserve governors are appointed by the US president with the approval of the US Senate. But once they're appointed, they can be dismissed, but the US administration or the US Congress cannot tell them what to do. That's the autonomy of the federal funds rate. Yes.
Yeah, excuse me, Professor. I have a question about the inflation index rate. I remember there are two ways to calculate the the inflation index of 5 years to maturity. And in fact, they can't be negative, I think, because it's 1 plus interest rate, and it is divided by 1 plus the inflation. So in this case, I think it is calculated by interest rate minus the inflation.
Yeah, they're for small amounts they are equal. So okay, this is if that it is 1 divided 1 plus r minus g to the power t equals 1 plus g to the power t divided by 1 plus r to the power t. So that 1 plus r minus
I
g,
see.
that can be negative. But very good question. Who is this?
It's Yishu Shao.
Oh, thank you. Very good. Very good. Okay, now the
Thank
parts
you.
that so the huge amounts. I mean, as I was mentioning, fixed income securities, it's so incredibly complicated. Now you can see why I prefer to do almost all my work on equities and options, right? Because they're just so much simpler to do. It's just look at this huge variety. I mean, it's just incredibly complicated. So the parts that we like to focus on are the constant maturity and Fed funds. So the kind of, we have talked about it, 1 month maturity, 3 month maturity, 6 month maturity, 1 year maturity, 2 year maturity, 3 year maturity, 5 year maturity, 7 year maturity, 10 year maturity, 20 year maturity, 30 year maturity. And the federal funds rate, remember, that's overnight lending, okay? Annualized, mind you, annualized return, but for overnight lending, okay? So this is here. Okay, I wanted to just show you just around the Great Recession. So 2009 and 2010. So the Treasury constant maturity rate is 0.05, 3 month is 0.13, 6 month is 0.3, 1 year maturity is 0.44, 2 year maturity is 0.81, 3 year maturity is 1.13, 5 year maturity 1.6, 7 year maturity 1.9, 10 year maturity 2.52, 20 year maturity is 3.46, 30 year maturity is lower than that, which can happen. The federal funds rate is only 0.22, which is very similar to the Treasury constant maturity 1 month, because remember, the federal funds rate is the only thing that the government can, the Federal Reserve can control. And this is what we say when the Federal Reserve made it into essentially free money. that money was essentially zero. So so you can look at some of these numbers here. Let's say in 2015. Look at it here. In 2015, 0.5, it's 0.01. The Treasury constant maturity is 0.01% maturity is the return on 1 month maturity. Even the federal funds rate is 0.13. The 30-year maturity is 2.96. Okay, so these are the various numbers. By 2021, and I'll later on in just a minute, I'll show you the daily data. One of the thing is, you remember what has happened over the last 3 weeks is extraordinary. Nobody predicted it. It was completely unanticipated. So we'll see. The monthly data still do not reflect what happened in the past 3 weeks because we don't have the data for March yet. So the Treasury constant maturity in 3 months is a healthy 1.55%. The federal funds rate is 1.58%. The constant maturity for 10 years is 1.76%. Not bad at all. The federal funds rate, for those of you who are interested, just you can look at it, how it has changed over the years. In fact, I just wanted to, let's just do a, what is the highest federal funds rate? So look at this. There are federal funds rate whether it is above 19%. So look at number filters greater than, let's just make it 15, greater than 15. There are actually quite a few periods in American history where the federal funds rate, once again, that is the only fund rate that any part of the government has any control over, has been above 15%. So lots of them in the early 1980s, and this is what is referred to as stagflation. This is President Jimmy Carter's. This is after he left office, but it is the culmination of, it was basically the stagflation, the recession that happened toward the end of President Carter's disastrous presidency, where the interest rates were just, incredibly high, over 17% per year. So these are the federal funds rate. So these are monthly rates. I wanted to kind of give you a sense. I want to now show you the daily rates because then you'll get a sense of how things have changed in the very recent past. Okay, so here, just over the last 5 years, I've looked at daily data. Okay, so daily data over the last 5 years, I've just put, just because I'm trying to get you an idea, Treasury constant maturity 1 month, Treasury constant maturity 1 year, Treasury constant maturity 10 years, and the federal funds rate over the last 5 years. Okay, I've done it the way we have always done it with these are the daily data, the different series, 1 month, 1 year, 10 years, federal funds rate. And then we got all these maturities. We have done it the way you are supposed to do it. When you're merging data, don't just stack data against each other because that's wrong. That's completely inaccurate. Sometimes you might end up getting the same results, but it's logically absolutely wrong. You lost about 10 points each if you did that in the midterm exam. And if you do that in the final exam, you will lose 25 points because the end result is absolutely wrong. You cannot just stack data sets against each other. You can't just stack fields against each other. So let's just look right at the bottom of this spreadsheet. So let's look at what happened this year. So we are starting off, everything is in the ones. This is January 2nd. Coronavirus at this point is really nobody, even in China, it's not fully understood. It's just a few people in Wuhan. It has not gone outside of China. And then it's still in the ones. And here, by the time you get to beginning of March, the markets have started reacting. Okay, that it's actually that it is a worldwide phenomenon. It's gone to 0.92, 0.48, 0.92. The federal funds are still at much higher, because remember, the Feds only move a few times each year. By the time you get to March 12th and March 13th, the markets have reacted. It's the constant maturity 1 year, 1 month is now at less than 0.5%. 1 year is less than 0.5%. To 10 years, because it's a different maturity, is just below 1. The federal funds rate is still at 1.1%. And this is now 316. Now, just to give you an idea, let's put all the dates in. I'll give you put them in. Okay. So Monday, March 16th, you can see the federal funds rate goes from 1.1% to 0.25%. That's one of the largest drops ever in the history of the Federal Reserve. 1.1% to 0.25%. And this actually happened on the Sunday night that they broadcast that they were going to drop it. So this is a hugely panicked crisis response to obviously the Great Secession. So, so you can see, and then the 3 days that we have, March 16th, 17th, 18th, these constant maturity numbers are, are rapidly falling, although the 10 years is not falling because there is, in a sense, that this is not a structural change. This is a really bad virus. It's not terribly fatal. It's only the very old and the very young and those with comorbidities that are going to be seriously ill, but it is very infectious. So, but the federal funds rate has gone to 0.25. Okay, so let me go take the dates off. Okay. Now I take this, and this is the chart that shows these 4 data series. This can you see this? Shing, can you see this?
Yes, sir.
Okay. So the blue rate, as the blue line, as you can see, it starts from pretty close to 0. This is the blue line is the Treasury constant maturity 1 month, goes up, and then goes down. And there's this huge drop right at the last couple of days, last couple of weeks for that. The next one, the red Treasury constant maturity, 1 year, as you can see, it starts with about 0.25%. It goes up, and all of this goes up and then falls dramatically in the last week. The constant maturity 10 years, because that's a different ball game altogether, because it's talking about 10 years into the future, is it starts much higher and it stays much higher, and then there is this dramatic fall right toward the end. The federal funds rate, as we can see, it is much more of a stepwise function, because it changes only a few times each year when the Federal Reserve's Open Market Committee sets the rates. And it's only toward the last few days that we see this dramatic fall. All right. Any questions about this? All right. So, so those are the federal funds, and the idea that we have talked about so far is that federal funds, the U.S. Treasury debt are considered to be risk-free. However, US municipalities, what are called the munis, are also issued by state and local governments, and they can go bankrupt, as has happened numerous times in the past. So the local governments can, in fact, go bankrupt. There is a very good possibility that the state government of Illinois might go bankrupt in the very near future. So the municipalities, what's actually, they're called munis, but they can be issued by local as well as state governments. The coupon income is not taxable, but the point is they have default risk and are rated. And the rating companies, what are called the CRAs, Moody's Investor Service, Standard & Poor's, and Fitch. And there are essentially two major categories, investment grade and speculative grade, which we will talk about, which I mentioned earlier, and we'll do a little bit more. Also, which we have spent our time, because so far we haven't really discussed the default risk much. We're now going to do some more of that. Who issues debt? Corporations. So corporations have default risk and are rated. Coupon income of corporate bonds is taxable. Why do we have these differential tax rates for various different bonds? I mean, it's just government gone crazy. Why can't we have a uniform system of returns of all kinds taxed at exactly the same level, as it should be, because they would be much less distortionary. Going back to the deadweight loss that we have done in microeconomics, minimize the deadweight loss by having them taxed at the same level. They're not. It's one of those things that we live with. It depends on who has more lobbying power. Foreign governments and corporations also issue debt. Now, this is the thing, sovereign debt of the US is considered risk-free because the US government has never defaulted on its sovereign debt, but other countries have. Russia has, Brazil has, Argentina has, Thailand has. So they are rated as well. So I'm going to now take you to another spreadsheet, another file, emergent data. All right. So can you see the screen?
Yes.
Okay. So this is, what have I done? I've taken all fixed income security data from Mergent, which is available on Words, which I have talked you through. I'll show you in, actually, let me just show you right away. Let's go to Words. Okay, can you see the words?
Yes.
Yeah.
Okay. So I'm accepting these terms and conditions, get data, all concepts. log in, okay. Okay, bonds and fixed income, Mergent FISD. Click on that. So I have this time sales data that I have downloaded because it's kind of, as I've mentioned to you, fixed income securities is incredibly complicated. So I've just downloaded it for 1 quarter of 2018. Okay, so let's see. Okay, let's see BA, that's Boeing. All right, can you see the spreadsheet then?
Rashid, we're still in the Wharton page.
Oh, okay. All right, now can you see the spreadsheet?
Oh, yeah.
Okay, so I've done a filter and I've filtered it for Boeing, which is BA. That's the stock ticker. And as you can see, actually before I do that, this particular data set has this thing as not all the yields are calculated, and that's not very helpful if the yield's not there. So I'm going to keep all the yields, but anytime they're missing, I'm going to not want it. Okay, so we want the, let's look at for Boeing. Okay, so you can see the trades that happened for Boeing in this time period. Now this here, each security, each particular issue has a different issue. So let's say the 2560s that you're seeing are one particular security, 2563 are another particular securities. Once again, as we have talked about, fixed income securities are profoundly complicated. So let's look at 2560 by Boeing. This is the same security, and it is traded for various prices. The yields, as you can see, for Boeing ranges between 3.6 and, well, that's basically in the 3.6 to 3.8 range between different dates in January that we see the trading. Okay, so this yield rate, the fact that it is higher, it's 3.6% is it's higher than the treasury rates, but it is not particularly high. And the reason is that Boeing is considered a relatively safe security, a safe company. The chances of it going under or going bankrupt are relatively low. Let's pick another of its debt issues. Here it is. The yields are actually quite a bit lower, and that depends on when it is maturing and so on, which clearly it would depend on the default risk over that period of time. Okay, so so these are all different companies that you can look at, the different fixed income securities. one thing that you will find interesting is, let's look at so Tesla has various different securities, and you can see that let's take a particular issue of Tesla. Let's just take this for no other reason except we just want to look at it. And 677.47, the yield is actually not particularly high. So in January 2018, at this point, the default premium is pretty low. The market is at this point in the first quarter of 2018, what we can conclude is that the market is of the opinion that the default probability, the probability of Tesla going bankrupt is reasonably low. All right. So you should play around with it, look at the data, get very familiar with it, be very comfortable with it, and so on. All right, I'm taking all the filters off. What is the range of defaults that we are finding? Okay, so I'm looking at all. What is the highest default we are seeing? Holy cow, look at that. Some of the defaults higher at 1,715%. 1,715%. Wow, that's a very high default rate. That's a very high yield rate. What exactly is going on? So, well, greater than 100% itself would be pretty high. So let's say we do a custom filter greater than 100. And let's look at this XCO. Okay, let's look at the numbers. XCO is the ticker in January 2nd, 2018. So remember, this is only data for the first quarter. Yield is 1,715. You'd say there's possible that this is wrong. If you see numbers so high, you should immediately be suspicious. You should do some detective work. So let's do some detective work. 1,715% yield. And it stays in the above 1,000% in, let's see, in January 2nd, 1,715. January 3rd, 1,602, January 5th, 1,213, January 5th, 1,247, January 8th, January 9th, 1,147%, and so on. 1,124, January 10th, 1,521%. So this is saying that the yield rate during this first couple of weeks of January for this firm with the ticker symbol XCO is incredibly high, above 1,000%. That is to say, so there is a huge default premium. So the market thinks this firm has a very high probability of going bankrupt. What's going on? Let's try to do some detective work here. Let's go back to our favorite data set, CRISP. Stock security files, daily stock files. Let's 70, 01, 01 to 2019, 1231. The ticker is XCO. Company name, ticker, price, return, date of next available information, amount after delisting, delisting price, delisting return. Let's just download this stuff onto an Excel spreadsheet. Actually, there's something else I want to look at, the cumulative factor to adjust price. Cumulative factor to adjust price. With the US style dating system. So can you see the words data set, the spreadsheet? The website is, I'm downloading data for XCO from, well, basically a wide range for the XCO ticker. These are the fields I've downloaded, downloading it as an Excel file. And let's see. So basically, I'm trying to see what happened with this firm in that period. Remember, we are seeing the yields to maturity for this particular firm's debt above 1,000% in the first few weeks of 2018. So what happened to this firm? Okay, while it is doing it, it seems it's taking a while to do it. It could be because the internet is acting up now. We'll come back to it, okay? Let me go back to the slides and we'll come back to it. All right, so as we said, corporations, foreign governments, they also all have different yield probability, different default probabilities, and as a result, they're rated accordingly. What is the credit spread? What is the default premium? So the LIBOR, the 3-month LIBOR is the London Interbank Offer Rate. This is the rate at which the various London banks lend money to each other. It is a very important benchmark in world financial markets. For instance, our mortgage rate is a function of the LIBOR rate. And so, so the LIBOR, you can think of it as a particular level of risk. These are major financial institutions. These are not your Boeings or ex-CEOs of the world, but this is, so what is the extra yield, the default probability premium that these companies charge? So this is the, what we call the TED spread. So as you can see, it is about 2.75% in the mid 1980s. During the Great Recession of between 28 and 2010, this credit spread went up to above 3%. So that's a credit spread between 3-month LIBOR and T-bill. These are indicative of how much extra these firms, these financial institutions were having to pay because of their higher risk of default. And as you can see toward the end, right at the end of 2020, again, that particular default risk probability is increasing. This is a bit older diagram, but I want to put in here to kind of see that you can see how the credit spreads, depending on the default premium, varies between different kinds of bonds. Right at the dark blue is the junk bonds, which are, we'll talk about in a second, which are not investment grades, which are significantly higher premium. And this is the difference. So you can see that in the Great Recession, the junk bond premium was close to 20%. Then the next one is the BAA rated, which is just at the border of junk and investment grade. Those were, clearly the default premium is positive, but they become much higher during the Great Recession, once again, because the risk of default is significantly higher. The AAA rated, which is the highest investment grade, clearly even the highest investment grade firm can go bankrupt. So therefore, it will have a positive default risk premium. There will be a higher yield than a treasury bond, for instance. We can see that it is positive, it goes up and down, but during the Great Recession, it was significantly higher. All right. Before we go to changing maturities, let me see if that the words has stopped working. All right, so it doesn't seem to be, the internet is acting up today. So XCO, it is actually remember, XCO is the company that we are interested in. It's actually the name of a company called XCO. So XCO Resources, Inc. So this is a company. If you go down here, about us, and you can see here, XCO Resources successfully completes financial restructuring. So in middle of July, it emerges from financial restructuring because it actually emerges from Chapter 11. Chapter 11 is one of the provisions of the US Bankruptcy Code. That means it went bankrupt. When did it go bankrupt? Interesting. Let's find that out. XCO Chapter 11 docket. Let's look at this. Look at this. On January 15th, 2018, XCO filed petition seeking relief under Chapter 11 of the United States Bankruptcy Code. So on January 15th, 2018, it actually filed for bankruptcy protection. So then let's go back to our Excel spreadsheet. Look at this. On January 8th, the yield is 988. So in the beginning of January, yield is 1715. So the market is very convinced that it is about to go bankrupt. And you look at this. So look at how high these yields are. It's because the market at this time knows that there's a very high probability that it is going to go bankrupt. In fact, the data I was going to show you earlier, in fact, I actually have it saved here. So I'm going to. So this is XCO equity data for the last 5 years. Can you see it? So from 2007 onwards, you can see some of the returns are pretty negative and so on. And then let's go right to the bottom. And you can see the last date for which we have data is December 22nd, 2017. On December 29th, 2017, it actually is delisted from the New York Stock Exchange because it's delisted at a price of 21 cents per share. The delisting return, that is to say, the last price that we saw was 64 cents on December 22nd, but on December 29th, which is when it is delisted at a price of 21 cents. This negative 66.96 is the negative return from 64 cents, the last price at which it was traded, to the delisting price of 21 cents. So at 12 on December 29th, it is delisted. And then the beginning, so end of December 2017, it is delisted. Beginning of January, there is, people are looking at it and saying there's a very good possibility it's actually going to go. Remember, delisting is not the same as bankruptcy, but it's very indicative that the returns are so negative, negative 66%. So its value has pretty much gone down. And so there is a very high default probability, which explains these very high yields all the way until it is it actually files for Chapter 11. Now we can see that even after it has filed, remember it filed for Chapter 11 on 15th, but even after the 15th, we still see this debt being traded. And that's not that surprising, because Chapter 11 means it's going to reorganize. At that point, it has not been decided how much of the firm's assets will go to the debt holders. So there is a high default risk, but that doesn't mean that you're not getting any of your money. So that's why we see how the default risk is imputed into the yield to maturity of a fixed income security. All right. Any questions before we move on? And by the way, Exco emerged from bankruptcy and went into, it reorganized itself, and it's now a privately traded, it's a private firm. Its equity is not traded anymore. Yes, somebody had a question?
Yes, Professor.
Yeah, I can see you. What could you identify yourself, please?
It's Rendan Guan.
Hi.
Because the screen, we haven't seen how to download the CRSP daily stock process at that time.
Yeah, don't worry about it. All I was trying to basically, the data that I just showed you, that I was going to download it in front of you, but I think the broadband speed is very low. Oh, that was the only point I was trying to make, that it was delisted on December 29th, 2017. And so in the first couple of weeks of January 2018, the market is pretty convinced that it is about to go bankrupt. Hence, there is such a huge default risk premium.
Okay.
Okay. All right. Now, what is the other aspect? So what are the different points that we have made? There is the coupon rate. There is the number of periodicity of interest payments and the maturity. So, so how exactly do bond prices change with maturities? So this is called the term structure of interest rate. And the idea is that typically what we see is that as the maturity increases, the yield of a coupon of a bond increases as well. So this here is this is a famous yield curve idea. This here is the difference between the 10-year constant maturity minus the 3-month treasury constant maturity. Okay, this difference is called the yield spread. It's a very, very famous result that we look at on a regular basis. And as you can imagine, it's typically positive. So 0 here is where we are saying, if it is above 0, it means the 10-year maturity is higher. If it is below 0, it means the 3-month maturity is higher. All right. So how much higher? Well, it depends. Over here, as we can see, in the early 80s, it's about 4. During the Great Recession, at some points, it is about, the difference is about 4%, and so on. One of the major okay, what do we observe here? It went below 0 in the late 1980s, and then there was a recession in the early 90s. It went below 0 in the late in early 2000s, and then there was a recession. It went below zero just before the Great Recession of 2008 to 2019. And then late last year, it went below zero. So this is the famous idea that when the yield curve becomes, the yield curve for the Treasury 10-year maturity becomes lower than the yield for the 3-month Treasury constant maturity, it's a leading predictor of a recession. This is a purely empirical observation. The theory behind it is not clearly understood. Mostly it is that, you know, there is no good reason for it to happen. So it's basically a recession is where things don't quite work. And so its idea is that when it goes, when this, it's called an yield inversion. When that yield inversion happens, it means that we don't really know what's going to happen. That's what is precursor or a leading indicator of a recession. So I'll ask you to kindly read this slide. So this recession forecasting tools, okay, so as I mentioned, this is a purely empirical observation that inverted yield curve means that a recession is about to happen. It's, you know, it's kind of it's a more episodic rather than a full-fledged clear understanding. So this Bauer and Mertens paper, I'm going to put that on right now. I'll put that on your screen, and let's read through that. Okay, this is from the Federal Reserve Bank of San Francisco, their economic letter. Okay, please read that first paragraph. By the way, this paper is posted on Blackboard. So the point here is every US recession was preceded by an inverted yield curve, and an inverted yield curve was always followed by at least an economic slowdown. Okay, so once again, it's an empirical observation, doesn't mean it always, not sure we fully understand. Any questions? Look at this. In its summary of economic projections, the median projection of the federal funds rate was 3.1% in 2020. In 2017, end of 2017, they were thinking the federal funds rate would be 3.1% in 2020. What is it now instead? 0.25%. This coronavirus has completely, the global recession that has happened has really changed everything. This is a very, very, very much of an outlier event. So I'll go back to the slides. All right. So once again, this inverted yield curve is something that is quite fundamental, and we need to be aware of it and go for it. Okay, this is an exercise I'd like you to do. Download the Treasury constant maturity and federal funds rates daily data from 2002 to yesterday for 1 month, 1 year, and 10 years maturity. Create a merged data set with all these fields, create a chart, and interpret, especially in light of recent activities by the Fed. This is exactly the kind of question that can be on your final exam. So please be ready to get some practice doing this kind of stuff. All right, any questions before we end for today?
Yes, where do we get the data from? Do we get it from Fred?
Yes, please. Yep.
Okay.
I mean, you actually can get it from Words as well. You can get it from either place.
Okay.
Any other questions?
So if the maturity, the interest to let's say 3 months maturity and 10 years maturity have changed, would that mean like there will be a like output change in the year, which will affect to the macro economics?
Sorry,
that's I mean just that was just a sentence I saw I read on the paper you showed to us.
Okay.
Because
so,
that said if there's an inverse in vertical curve, the short-term maturity would be greater than the interest of long-term maturity. The output would be lower. There was a sentence mentioned that. So would that mean if short-term interest is higher than the long-term interest, would that mean a deduction in the output?
Yeah, that's one hypothesis.
Okay.
Yeah, there is. I mean, we know it's a good predictor. Rather, that's not the correct statement. We know it's that sequence. Every single recession had an inversion before it, and every single inversion but one had an economic slowdown following it. Now, whether that particular observation is generalizable into the future, whether you can extrapolate from that to the future, will depend on an economic theory behind it. And that is not fully understood. And the economic theory, for that to make actual sense, you have to test the hypothesis with actual data. So that is one hypothesis, but it's not something that is fully understood either. So, okay. For you to be able to generalize, you need a proper theory, a structural theory, which is then tested with the data. In the absence of that, you can either have a purely theoretical statement or a purely empirical statement, which is that like this curve that you see, that the fact that the inverted yield curve is followed by a recession, that's a purely empirical statement, right?
Right.
All right. Do we have any other questions? And thank you all very much for your comments today. It's been very good. All right. If you have any questions, please do email me. Otherwise, hope you enjoy the rest of the week.
Thank you.
Thank you.
See you.